Thank you, Chowni. Hello, everyone. My name is Pratima Divgi, and I am the director for CDP in Hong Kong. For those of you that are not familiar with CDP, we work with corporates, financial institutions, and policymakers on environmental best practice. We're also the founding member of the Science Based Targets Initiative and Renewable Energy 100, or RE100 as it's more commonly known. The topic that we have today is a fairly wordy one. Let me just get it out. It's navigating climate neutral investment opportunities, climate related risk management, and disclosure in Asia. And I think it connects well with the topics that we discussed this morning, which has been much more from a market perspective and a support infrastructure for a carbon neutrality ecosystem that Hong Kong is wanting to be a huge part of. Joining me today are very distinguished speakers. We have 3 online and 3 in person. So in no particular order, we've got Helena Fung, who is Head of Sustainable Investment APAC at FTSE Russell. We've got Sammy Leung, who is Climate and Sustainability Leader at PwC. We've got Emily Woodland, who is co-head of BlackRock Sustainable Investing for Asia Pacific. And online, we've got Elaine Ng, who's joining us from Singapore. Elaine is Senior Manager, International Affairs and Sustainable Finance with the Securities and Futures Commission. We've got Jingwei Jia. Jingwei, are you joining us from Shanghai or Beijing? I think you may be on mute. We're not able to hear you. Sorry, I think we've just got a slight issue with the technicalities, so we just. Anyway, Jingwei is joining us from the mainland, and he is the Chief Executive Officer of Swiss Re Corporate Solutions, Greater China. And we've got Ian Drew, who's based out of Hong Kong and is the Regional Head of Risk Strategy at HSBC. Taking all of the conversation that we've had this morning on what the market needs are and what the support infrastructure that's coming along for the markets, I think we wanted to take this panel more from a practitioner's point of view. So, how are the finance sector and regulators really integrating climate risk management within their investment considerations? What are they doing in terms of the strategy build, the post-investment monitoring, as well as how are they assessing current climate information into green and sustainable finance? Sorry, just wanted to check. Is it sorted? Can one of you say hello to me? Elaine, from your side.
Hello.
Hi.
Jingwei.
Perfect.
Can you hear
All
me?
good. All good.
Okay.
So we divided this panel across 4 themes. We've got disclosure, we've got climate risk management, we've got obviously the data and the index and the methodologies that practitioners are using, and then we've got the opportunity set. So let's start with disclosure. And Elaine, let me come across to you with that. Perhaps you could just start with sort of highlighting, what is SFC's approach been to climate-related disclosure? Any key highlights on SFC's current efforts on disclosure, as well as next steps that you're looking at, and how are you actually working with other collaborators, let's say the ISSB and other regulators in the region on the topic of climate disclosure?
Well, thank you very much, Pratima. I just want to make sure that everybody can hear me clearly.
All good.
Okay, perfect. Yes, well, first of all, before I begin, I want to thank the organizers for putting together this very action-oriented program. I think we are happy to be talking about next steps, very much instead of talking about what's happened in the past. I apologize that I cannot attend in person, and I hear with envy all the networking is going in the background. I wish I was there. If all goes well, in 30 hours, we'll be landing back in Hong Kong. Omicron notwithstanding, getting in the way. So to your question, I don't know how many of you in the audience actually remember this, but it was at this very forum 3 years ago, and in its inaugural edition, that I was sitting in the audience and watching Ashton Older, the CEO of SFC, talk about a strategic framework for green finance for the SFC. And fast forward 3 years later, he's my CEO, and I'm happy to say that, of all the areas of focus that the SFC had laid out in that strategic framework, a large part of it has been achieved. So that kind of frames why we at SFC, how we have approached this, right? One of the key areas of focus was to enhance disclosures and the consideration of ESG and climate factors by listed companies, by asset managers, and for product disclosures. So over time, you were seen, and I'm not going to go into a lot of details here. If you don't know it, you should go check it out because those rules are coming in play very, very shortly. So 3 areas that we have actually systematically worked through this, right? We've worked with the exchange over many months. So the latest version of the ESG disclosures for listed companies was put in by the exchange in July of last year, and there are more enhancements coming. So we should watch out for that. The consultation that we did on asset managers to consider climate factors in their investment process as part of risk management and embedding that into your governance structures, that has been finalized in the latest amendments to the Fund Manager Code of Conduct. That was issued in August of this year, and it will come into play in August of next year. The first phase of it will come into play August of next year. And in June of this year, we issued an updated circular for ESG funds and the necessary disclosures that need to accompany it if you want to market your fund as an ESG or a climate fund. So essentially, we've tried to build the infrastructure within the investment community that climate considerations are very real, have very real financial impacts. That needs to be worked into the risk management process. It has clearly a lot of opportunities, as we have seen this morning, been discussed. So that needs to be part and parcel of your investment process. How do you identify, capture it, monitor, and manage against it? And very importantly, and I think this is quite common sense, is if you market yourself as an ESG fund, you have to demonstrate how you are different from a regular fund. Right. So these will be, essentially the key highlights, I would say, of what we have been doing over the last three years. Quite a lot, I think. And I'm happy to say that we've grown from a small team to not bigger by numbers, but really integrating it into the various different divisions. Mainstreaming, I guess, this thinking around sustainability and climate. Should I talk about our work on the international side, how we are collaborating?
Please, that would be really helpful.
Okay, so that's a lot of the work that's being done in Hong Kong. As mentioned by Paul Chan, our financial secretary, and Margin earlier, Hong Kong really needs to plug itself into the international landscape. We cannot differ dramatically because we serve international investors, and we are a super connector, as Grace had already mentioned. So we've participated very actively in the international scene. Actually, the CEO of SFC is also the chair of IOSCO, which is the International Organization of Securities Commission. This is really important because at the IOSCO level, the board had set up a sustainable finance task force to look at the issues that concern securities regulators globally and whether or not a concerted or collaborative effort can be put together to deal with some of these concerns. I mean, so, at the forefront of every securities regulator is the risk of greenwashing, right? This is something that will threaten to derail the growth of sustainable financing. It erodes investor trust. So that needs to be dealt with. And as more and more companies get into the space, more and more asset managers getting into the space, then, there needs to be certain guardrails within the industry of where to go, where not to go. And I think that is the response that needs to come from the global regulators. So on that note, IOSCO has been pretty busy with at the Sustainable Task Force, the STF. So in the last 6 months, we have put out 3 different reports targeting 3 different areas. The one that has made a lot of splash recently at COP26 is the work that we've been doing with the IFRS Foundation on issuer disclosure or corporate disclosures. IOSCO had published a report in June of this year outlining basically some of the key considerations that need to go into the build of a global baseline for corporate reporting. What is necessary, what investors have asked for, what regulators will be looking for, and that's all covered in that particular report. And we are taking this report to engage with the IFRS Foundation, which has, as everybody knows, set up the International Sustainability Standards Board at COP26 in November this year. So the work group at IOSCO has also now formed a technical working group. So under the Sustainable Finance Task Force, there's now a technical experts group that will look to evaluate the future standards that will be produced by the ISSB, or the International Sustainability Standards Board. I'm not going to go into a lot of details here, but the work is quite intensive. We participate in both the STF as well as with the TEG, and we will be looking to really dig into those details when they come about.
Thanks, Elaine. I think the kind of message that I'm getting is, there's sort of the disclosure area where you're already working with accounting bodies such as the IFRS. You're already working on areas of labeling, especially in terms of differentiation between regular products and what are sustainability products. And, across jurisdictions, what is the common standard that we need to have in place for companies, for financial institutions, so they can actually better interpret all of this information that keeps coming out in terms of ESG. I want to take this to Sammy, giving your consultant hat. What are your reflections on, how companies are adapting to this environment, this very, very fast-changing environment, especially when Elaine spoke about what was it 3 years ago and what it is now, and the pace at which it's going to go ahead. What has been your reflection?
Right. Thank you. And I'm going to answer your question real quick. But before that, Elaine mentioned 3 years ago, everything started as we talk about, that's strategic framework. That's also the same day, the inauguration of the HKGFA. That's September 2018. And right after that, that's the industry-wide survey that Hong Kong has launched. Not because of Elaine is here, and I need to mention the Securities and Futures Commission. It's because of I'm the partner in charge who did the year-long project. And I think that's really the milestone that the industry, the asset manager in Hong Kong, start talking about climate change or climate risk. Before that industry-wide survey, people start talking about ESG integration. People were discussing about different investment strategies. There were a few European-based funds that they have been looking at climate risk. TCFD seems to be a concept back then. That's 3 years ago. And so back to the question, the reaction of the companies listed and also private have been addressing the climate risk or how they go about it. I think it's amazing to have the front row seat, spending time with clients day in and day out. That previously, when we start talking to the board of directors, updating them about these other trends, 3 years ago, the dynamic, the reaction were pretty different. Is some potential in the horizon of type of recommendations made by some really far away international bodies. A bunch of experts spending hours and years published the recommendations back in 2017. That's a concept. But 3 years later, the people in the room, number one, is different. So it's no longer just the sustainability experts. It's no longer just the risk people. You will see strategy people, C-suites, and the questions that they are asking will be different. So the whole momentum, in short, I think is changed from a compliance perspective to a more business-relating relevant decisions. It was started, I would say, majority because of the investor push. That's how they reacted to. Interestingly, we also see corporate customers, like there are private, not listed clients that they also needed to jump on doing a bit more on the TCFD disclosures because companies like Lenovo and Dell, they would be asking the supply chain, which are the OEM clients, they privatize already, but they need to really catch up on all these climate change resilience. So that's the driving forces, and people are changed. People who are in the room are changed. The questions are no longer asking why. They ask what, and and they start challenging. Oh, are we adopting this scenario will be enough? And technicality, the fluency, are getting higher and higher. Also, they ask not only just about risk. C-suite start asking about, so how am I going to do and go about these opportunities? So these are the real day-to-day interaction that we witness.
Thanks, Sammy. I think it's interesting you especially talk about the strategy, because if you really sort of look at the TCFD framework or the climate-related disclosure framework, it integrates very nicely with the enterprise risk framework. You can take every aspect of the enterprise risk management framework, and you can put in each aspect of the TCFD in it, and it just integrates beautifully. So it's always had a strategy angle. I think people have, as you mentioned before, kind of companies have approached it from a risk compliance perspective, and now are actually seeing it from a strategy perspective. But more importantly, you're getting answers from the C-suite now on what are the value drivers of this disclosure.
These days there are at least around a dozen of our blue chips company. They already started integrating climate risk and opportunities into the formal enterprise risk management program. 3 years ago, maybe there are 3 of us, the more internationally exposed one of certain sectors. But these days, at least they are already trying doing that. 2 years ago, if you talk to them and they will debate about the time horizon is different, how am I going to do that? We're just doing a qualitative approach, but the momentum has changed a great deal.
Yeah, absolutely. I want to kind of move to the second theme now, which is really climate risk management, and from a financial sector perspective. And I think this is where, having an asset manager perspective, a bank perspective, and from an insurance side would be particularly helpful in just kind of understanding, how are you approaching current climate data into this investment considerations and decision making. And Emily, perhaps we'll start off with you, and then we'll have Jingwei and Ian join in as well.
Thanks very much. Great to be here today. Thank you. Good to see some people in person for a change. So look, there's 2 ways to frame the answer to this question. Firstly, how are you approaching climate investing from a top-down perspective in your asset allocation? And then also, how are you approaching it from a bottom-up perspective when you're doing your stock picking or your portfolio construction? And then obviously the third element for us as an asset manager is then how are we approaching it from a stewardship perspective as well. So I'll take those three things in turn. I'll try not to take too long. From a top-down perspective, in February of this year, we actually incorporated climate risk into what we call our capital market assumptions, or our CMAs. And those form the cornerstone of our asset allocation recommendations. And that modeling was done via three main transmission mechanisms. First of all, the macro channel, so how climate risk can impact things like risk premia in the markets. Secondly, the repricing channel, so how the changing flows of funds in particular, as in into more sustainable assets and out of less sustainable assets, how that actually might impact cost of capital in the market. And then third, the fundamentals channel, so how climate change can actually impact sectors in terms of their profitability. So we combine all of those three together, and that actually impact our asset allocation recommendations from a macro perspective. And then if we think about this from a bottom-up perspective, now, the way that you integrate this into your investment process, it really is not a one-size-fits-all approach, because it really depends on an investor's objectives. And there's a whole range of preference as to what investors actually want to achieve, both in terms of sustainability outcomes, but as well as risk-reward targets. So if we think about our entire active platform where we're making active investment decisions. Now, we believe as a fiduciary it's actually our responsibility to incorporate all material risks into our investment decision-making process. And that's why, as of December last year, we actually went fully ESG integrated across our whole active investing platform. Now, if you take that up a notch and you think about sort of dedicated ESG or sustainable strategies where sustainability outcomes are also an objective of that strategy, as well as financial objectives, there's a whole range of investor preferences there that everything from just simple exclusionary screens on things like fossil fuels all the way through to targeted ESG impacts and outcomes where you want something measurable and tangible in terms of sustainability impact. And so the way that you integrate climate data and other information really varies across that whole spectrum. And the idea is to be able to offer solutions that cater to all of those diverse and complex needs. Then, the third element is how we integrate that into our stewardship activities, which apply to both our index as well as our active platforms. And that's also an essential component of our fiduciary responsibility, because the money that we manage is not our own. And these are really long-term issues, and a lot of the assets that we're holding are very long-term assets. So we really have to integrate these considerations because they are material to long-term investment outcomes for our clients. Our conviction is that companies perform better over the long term when they're deliberate about these issues and they're actually really cultivating their strategies and their capital allocation in accordance with these risks and opportunities. So we've been engaging with companies on sustainability and particularly climate issues for a long time now. For example, last year, our global stewardship team had 2,330 engagements with companies just on climate and natural capital alone. And we've been advocating for companies to push for TCFD-aligned disclosures specifically on climate, but also SASB-aligned disclosures on ESG more broadly as pertains to the materiality with which it actually can affect your investment outcomes. Given the groundwork that we've laid and the growing focus on sustainability and the increasing materiality, particularly around climate as pertains to investment outcomes, we've been becoming increasingly disposed to hold directors accountable for not having these issues appropriately incorporated into company strategy. So, for example, last year we voted against 255 director elections for climate-related concerns. And 319 unique companies that we voted against for climate-related concerns. So ultimately, I guess we believe that companies that are critically evaluating these issues and setting baselines, setting targets, and acting with urgency are really those that are likely to do the most well. And we do tend to focus those efforts on the most carbon emission intensive companies. So we have a focus core of about 1,000 companies that represent about 90% of the scope 1 and 2 emissions that are basically represented by our clients' assets. And so we are focusing our efforts mostly on those so that we can really help move this conversation forward on climate risk management.
Thank you, Emily. Jingwei?
Sure. I hope this time you can hear me. So I'm really happy to join the panel today, and especially the diversity offer me the great chance to share some of our Swiss Re's view, but also to learn from everybody. I think everyone probably knows insurance is one of the largest group of investors in the asset management side. Swiss Re, as one of the largest reinsurance companies, probably have a little bit more influence to the insurance industry because we cover a lot of the exposures from the insurance entities, and we're happy and being active sharing our views on the ESG. So it's interesting because climate risk is one of our basic risks to cover over the past 200 years in the insurance industry. And we started from marine risk, and then the heavy loaded exposure right now is natural catastrophe. And we see the impact day by day in terms of how much the exposure will be, what is the different risk, how we're going to price, and the cost in terms of the exposure, the claims, but also the frequency and the severity is happening every year. So, but apart from the kind of a core element of insurance, that's how we transfer some of the risk out. We also offer some thought leadership and the insight to share. For example, we have the risk insight services globally, but also very prominent in Asia, which means we come with a model with our hundreds of years data on Nat Cat, but also incorporate into each corporate own profile. And we run with the weather impacts on their core business, the potential scenario testing. We also consider some social impacts and design the risk transfer solutions to reduce some of the impacts, and also see whether they have other ways to reduce the loss for themselves. So this is going beyond the insurance, but we think ultimately it's going to make impact on the ESG scoring to themselves. If anything else I can share, I think insurance can also use data to look at the climate risk from reducing uncertainty point of view. There are tons of new investment on infrastructure, whether it's carbon capture technology or others. The investors are not sure whether and how much the return will be, right? Right now, the cost is still a key consideration for them. If insurance can step in more and more, I think that will help the whole industry and also the investor community to support more projects like that. And also that will facilitate more trading in this environment. I think finally, it's about innovation. I think a lot of technology and trading and others, credit is also to do with the new technology that needs to bring more comfort level to the public. And insurance can come with some innovative ways using historical data and the projection on the future data to reduce the credit trading risk by compensate if the credit trading fails or underlying assets are diminished. So I think those are a few points that are probably unique for insurance, but I think overall we're supporting the industry and the whole ESG theme to grow.
Thank you, Jingwei. Ian?
So good morning, everyone. Can you hear me okay?
All good.
Excellent. Well, thank you very much. I mean, I'm very grateful for the opportunity to join this Hong Kong Green Finance Association event, and I'm sorry that I can't be with you all in person, but I'm delighted to spend the next 5 minutes or so just considering climate risk management. I mean, as we come to consider the management of climate-related risks, I think it's worth taking a step back and reflecting on how those risks come about, and the role that finance institutions will play in addressing climate change. I mean, there's clear evidence that if left unchecked, climate change will have a devastating impact on economies and communities, and many of those that will be most affected are here in Asia. I mean, Asian governments recognise that action needs to be taken and have largely set clear targets for reducing greenhouse gas emissions, with many setting deadlines for achieving net zero at some time between 2050 and 2070. However, achieving the right actions that will balance the need to address emissions while supporting economic growth and thereby achieving a just transition is one of the key challenges facing Asian governments. And those policy actions that will be implemented to achieve these goals, the expectations of consumers that action will indeed be taken, and technological advancements that will be made to support that, each introduce a risk, and a risk we refer to as transition risk. This will impact business models and personal choices as we collectively transition to a carbon neutral world. Finance institutions such as HSBC have a clear role in supporting customers as they do so, be that, for example, in supporting the manufacturer of fossil fuel powered cars, refine their business models to manufacture electric vehicles, or supporting personal customers retrofit homes to be more energy efficient. Now, notwithstanding public commitments to achieve net zero, we're not yet on a path consistent with the ambition underlying the Paris Agreement, i.e. to ideally limit increases in global temperatures by the end of this century to be no more than 1.5 degrees above pre-industrial levels. We've already seen increases in excess of 1 degree Celsius, and quoting HSBC's ESG research, the pathway to 1.5 degrees increase is in sight, but we're not yet on it. And if we stay on our current trajectory, we're still headed for 2.4 degrees increase. Now, these increased temperatures will expose communities and economies to the next climate-related risk, i.e. physical risk. This could be the acute physical risk that Jingwei was already referring to, i.e. the impact of more severe and or more frequent weather events, or chronic physical risk, i.e. the impact of higher temperatures and rising sea levels. Businesses and individuals will need to adapt to these new circumstances, for example, by enhancing the resilience of properties against more intense storms, or investing in, for example, facilities for chill distribution. And banks will have a role in supporting customers by financing these adaptations. Now, banking regulators and supervisors are well aware of these risks and are developing macroprudential and microprudential responses to consider these. Most notably, they're developing guidelines that require refinements to risk management frameworks, require enhanced disclosures, and the undertaking of stress testing and scenario analyses to consider what are future and highly uncertain risks. Such as scenario analyses are essential, as historical experience cannot be used as the basis for considering the future. And these scenario analyses need to cover a much longer time frame than would normally have been considered within business planning. Now, financial institutions such as HSBC have taken important initial steps with net zero commitments and the development of climate risk frameworks. Driven by internal ambitions, by stakeholder expectations, and by regulatory requirements, HSBC and other institutions have committed to reducing its own emissions to net zero by 2030 and to reducing our financed emissions to net zero by 2050. The achievement of net zero within our customers' emissions, therefore those financed emissions, is key. Now, risk management has an important role to play in enabling these ambitions. We've been integrating climate-related risks in our risk management framework. This involves refining our appetite for the level of risk that we may wish to be exposed to, and updating our day-to-day risk management to take into account climate-related risks. Whilst initial steps have been taken, these will need to be enhanced over time. We do not consider climate-related risk as a separate risk as such, but instead take this into account as a key driver when considering other existing risk types. Those risk types thought to be most impacted include credit risk for both businesses and personal customers, resilience risk, i.e. the resilience of our own operations, regulatory compliance risk as we consider meeting these new regulatory requirements, and clearly reputational risk. Doing this in an effective way means embedding across each of our 3 lines of defence, and we've been investing in raising awareness and building capabilities across all levels of the organisation. It also requires effective governance mechanisms to ensure that these risks are correctly identified and reported to management and to non-executives. Now, and this really comes to one of the questions we've been asked, one of the key challenges in embedding climate risk management is actually the availability of climate data for clients. This could be, for example, emissions data, their transition plans as they transition to a low carbon net zero business models, or asset level data on exposures to physical risk. The landscape for climate data is evolving and disclosure requirements are progressively becoming mandatory across many jurisdictions, and data is being made available by vendors. Disclosures have been discussed earlier in the session, and the recommendations of the Task Force for Climate-Related Financial Disclosures, or TCFD, mentioned by Sammy earlier, play an important part in this. Work needs to be done, to be able to gain access to information held, for example, by public bodies, and in the sharing of data in an appropriate manner across the industry. And sharing of data between industry participants could really help with that. For example, much information is held by the insurance industry on physical risk data. Given the complexity and criticality of data, financial institutions need to define data strategies, and we need to build robust infrastructure to support the execution. Different data needs to be sourced when considering response to transition risk and response to physical risk. Our ESG data and analytics team is instrumental in supporting our data requirements across each of the 3 lines of defence, in leveraging information available internally and externally, and providing analytics capabilities. Whilst some data and much of that data may be available from public sources and from vendors, much actually needs to be gained directly from clients who, in many instances, have not previously had to consider such requests. Now, some years back, HSBC developed a transition and physical risk questionnaire that supports engagement with our clients on the risks that they face in the medium-long term, their governance process to manage such climate risk, key metrics such as carbon intensity, and their financing requirements to support transition or adaptation. These questions have been used to support engagement with customers in carbon-intensive sectors. These sectors are broadly consistent with the subsectors that the TCFD identify within their guidance. TCFD have identified those sectors based largely on those which emit the most greenhouse gases, those which use the most energy, or those that consume the most water. The very last point I would like to make is that whilst we have been engaged across these sectors, these are the initial ones to be focused on, as customers in all sectors need to be engaged in general over time. Every customer has a role to play in achieving net zero, and similarly, every customer may need to adapt to the impacts of climate change. So thank you. I'd really like to sort of draw an end to my the discussions there.
Thank you, Ian. I think kind of looking at it from the various aspects of the financial sector, we've got the asset manager perspective, which is very much from the viewpoint of asset allocation, from the viewpoint of top-down integration, stewardship. We've got the insurance perspective, which is really on working with clients on risk transfer, on transfer solutions, as well as arriving at areas of credit trading risks. And we've got the bank view where I wanted to specifically touch upon that because you mentioned about data and managing current data into making investment decisions or lending decisions, or taking into account sustainability. And here, this is where I'd really like to bring Helena in, because HSBC's made this commitment on net zero, and I think there's about 2,000 companies globally that have made a commitment to science-based targets or net zero. What are the approaches that you are seeing investors sort of really take in integrating all of these net zero objectives into their portfolios?
Sure, thanks for the question, Pratima. And I echo what you've just said about the diversity of the panelists that are here in this discussion today. And I think it's really important, actually, just to emphasize that this requires a whole of industry approach, right? So we're all coming at this from different angles, whether it's regulatory, whether it's the banks, insurance, asset management. And I think, the work that we've done so far in scaling up focus and attention in this area is tremendous, but it really does require really all of us from our different angles to work together and do what we can. And I'll speak a little bit certainly to your question, but also to how we as a benchmark provider are instrumental in this effort and what we can do. Because obviously, we have an outsized influence, I would say, in many respects on the capital markets. We have about $17 trillion worth of assets benchmarked to FTSE's indexes. So that gives us a really great platform to be able to engage. And just to the point about sort of company commitments to the net zero agenda and HSBC, I would say we're also owned by a stock exchange, and the LSE was the first stock exchange to make a net zero commitment in its own business. Was also a founder of the Net Zero Service Providers, Financial Service Providers Alliance under GFANZ as well. So it's obviously something that's really important to what we're doing, and I think touches on a number of the things that have been raised. Actually, Elaine talked about the regulatory frameworks, the need for greater product labeling, for disclosures, combating greenwashing, and she mentioned also the IOSCO consultation. And I think what was really clear from that was the need for very sort of, transparent methodologies. And I think this is where Index actually kind of comes into being really well, because we produce licensed and regulated products. It's really important that we're very transparent with our methodologies, with our data inputs, that we do what we say we do. So we're in a very sort of scrutinizable perspective. And I think that's also something that's very important. And noticing and I think reflecting on sort of the incremental focus on product labeling and regulation around ESG and sustainable and climate products, which I think actually is in some ways a reflection of the success of this space, is something that we really welcome. I think certainly from the ASCO consultation perspective, this is an area where I feel like we actually have always been walking the talk, publishing our methodologies. We're involved now also with a number of sort of open source data type initiatives like the Transitions Pathway, which publishes an online tool together with the Grantham Institute at LSE. We publish the methodologies, investors can access the data tool, which gives a number of different dimensions of company analysis and reporting, not least of all, how companies are implementing TCFD and how they're managing on carbon reduction pathways in the real world as well. So I think that's something else to note. And also just say, in terms of the frameworks that are coming out of Europe, these are also having an interesting kind of global reverberation as well. So I'm going to mention specifically on kind of the net zero agenda. And I think if we think about how investors can take all of these sort of different aspects that I think people have touched on, whether that's kind of the bottom-up approach, thinking through what companies are really doing on the ground to manage climate risk, or whether it's the sort of the top-down portfolio construction that Catherine was talking about, I think there, really we can combine all of this, within an index approach. The other piece of regulation, of course, is SFDR, and thinking about the influence of that here. And I've noticed also that is referenced in the SFC circular on ESG disclosures that was released in June. So I think we're seeing also a sort of a global coming together as well of what investors are looking at when they're scrutinizing ESG options. But one thing I do want to mention is just the EU BMR and the influence that that's having, and also some of the scientific pathways that are included in that. So, for example, we, as many index providers, have released a suite of EU Paris-aligned and climate transition benchmarks. But what we've really tried to do in Asia is think through what does that mean from an Asia perspective? We've got a number of different economies here. We've got climate net zero objectives by 2050. We've got them by 2060 in China, now 2070 in India. So how can we take that sort of very sort of science-based framework that I think the EU TEG did a great job of coming up with, and then really relate that to the economies that we have here? So we know that the TEG had based their decarbonization trajectory of 7% per annum on the IPCC's recommendation. So what's interesting to think through is then how do you relate that from an Asia perspective? And we have just announced that, or just recently around the beginning of the COP in Glasgow, announced a partnership with JPX to develop topics, to develop net zero indexes for the Japanese economy based on topics. And that was a really interesting project for us to go with, because obviously we had an engagement with JPX to structure that and to think through the approach. But we also then took that further to an industry consultation and really sort of looked at the framework that's set up by the TEG, and they've done a lot of thinking around what this means in terms of integrating net zero into benchmarks. And then we engaged more broadly on that as well with the industry, with JPX. And we found there were a lot of really interesting, relevant aspects that actually we wanted to retain in that. So I would just say, to wrap up briefly, the importance of benchmarks is in that kind of visibility in helping investors to achieve and to sort of roll out their sustainability, their net zero, their climate objectives across larger pools of assets. So I think, just going back to what I said at the start, it's really important that we provide solutions for different economies and within different parts of the financial sector as well. So I think that we're particularly involved in really thinking through some of these solutions and how we can bring these to the Asian market.
I think just as a follow-up question to that, because I think a lot of what you mentioned comes from also a regulatory and economic perspective, but on the ground, when you have corporates and financial institutions providing their disclosure, it's a lot of it is not particularly comparable, or at this point, we're not able to kind of do a like-for-like assessment, probably on certain metrics, but definitely not on all. So you've got a lot of qualitative and quantitative data that comes with it. And how do you balance that within an index development?
Well, I think that really goes down to how you approach the data, right? So there is some data that will lend itself quite naturally to a very quantitative approach. So carbon emissions data or fossil fuel reserves may be one of these. On the other hand, you've got a really important qualitative piece as well around assessing what companies are doing, as we said before, from a bottom-up perspective. And here, I think looking at frameworks like TCFD and using these as an approach for assessment. And I mentioned the Transitions Pathway Initiative that we're heavily involved in. Yes, it is about sort of looking at qualitative disclosures, but then mapping those against really specific frameworks and making them very sort of repeatable so that you can really see what companies are doing. You've also got to think about different sectors as well. And what does this look like potentially from a sectorial lens? Also, so it's really how do you marry those? But ultimately, if you're making a benchmark or if you're constructing a portfolio in an index context, then you need to be able to bring everything back to a sort of very quantifiable, repeatable, consistent and transparent methodology. That's not only for the index construction, but also really for the data that goes into building that index.
Thank you, Helena. I want to, in the interest of time, sort of go into climate opportunities, because that's an area that I think a lot of people are focused on. And within the financial sector, maybe I'll just start off with Sami and then Emily as well. What are your reflections on corporate maturities to transition pathways? And of course, we've sort of heard of from a regulatory perspective, what's coming down, which is a lot more sort of setting the foundations and disclosures, etc. But some companies, especially the ones that are setting net zero targets or science-based targets, they're already kind of working on strategies for transforming their business model in line with what they expect will happen in 20, 30 years. So what are your reflections on that, and what are you seeing in the market?
Right, thank you. There are early movers that they started a couple of years ago. If you think about the higher carbon industries, they actually saw that coming if the management really know about the whole market trend. So there are obviously power companies, utilities provider that they have been looking at exploring, trying to do more mergers and acquisitions around the renewable space. Then if we think about the journey and the pace, I think those who understood that and who embraced it and then it's a matter of timing and how you prioritize. You lower some of your return on investment in a way, and then you map it out to the timeline and the roadmap that you believe, and balancing the policy changes and the other technological advancement. So bringing back to what we are seeing, if we think about the last year, it's like eye-opening to see the collaborations, the cross-sector collaborations. Is like if we look at Hong Kong, real estate sectors, the alliances and the collaborations, you see real estate giants that they collaborate with universities, in science-based target projecting, or just as simple as construction site, they will be using solar energy. And then there are advantage or competitive advantage that they already could announce. Examples like, oh, these properties that we are developed, which has a, say, EV charging 1-to-1 resident to 1 charging facility ratio. So there are different ways that you see the creativity generated by cross-sector collaborations, and call that a transition pathway, or call that they get it, that's the opportunity, we want to go about it, or as simple as the investor expect them to be integrating your ESG thinking into your growth strategy, and tell us how do you translate it into your growth plan, etc. So these are what we are seeing day to day. So my reflection would be, the early movers are starting to get a bit of the advantage, but I think this journey, if we hear what the other panelists have been talking about the carbon market, I'm pretty sure 3 years later, if we get together, it will be very, very different to what we could even imagine today. That's my thinking.
Thank you, Sammy. Emily?
Thank you. Yeah, so the methodologies and tools that are out there in the market right now for assessing corporate alignment with various different sort of temperature outcomes, they're still quite nascent, they're quite varied, and of course, as we've touched on, the data can be a little bit patchy. But some of the tools that are out there right now will tell you that the overall market globally is aligned to something like a 3 or 4 degree outcome. So obviously well above the Paris targets. And obviously that means that most companies have still got a very, very long way to go in terms of their transition pathways. But I'm an eternal optimist. So there's 3 things that really give me cause for optimism on this question. And the first is actually what we saw at COP26, and our global head of sustainable investment was there, as was our CEO Larry Fink. What was interesting was for the first 25 editions of COP, really the international negotiations took center stage, and then the private sector trade fair was very much a sideshow. What was interesting this year was the increased participation of the private sector and the financial sector as well. And actually, while there were some real key national level developments, actually a lot of the key developments were actually cross-border. They were financial, they were technological, they were sectoral. And that gives us a really strong indication that the climate action movement is actually starting to rewire itself according to the way that the global economy actually works. And the presence of the private sector there just tells me that the corporate sector is actually starting to really wake up to the fact that it can't be left behind as part of this transition, because the transition is here to stay. The second thing that actually has been touched on by a few of the panelists is the Science-Based Targets Initiative. Now, this is one of the gauges that we use to kind of check corporate credibility in terms of their transition pathways. As you pointed out earlier, there's 2,200 companies now taking action via SBTI. That number tripled from 2020 to 2021. And half of those companies have verified science-based targets, and that covers $23 trillion of market cap. So, I'm quite encouraged to see the direction of travel. The other half have to have those targets verified within the next 2 years. And then the third thing, along a similar vein, is also the support that we're seeing increasingly for TCFD. So now, as of October the 6th, fresh off the press, the TCFD had over 2,600 supporters globally. That's a 70% year-on-year growth. Now, of course, that doesn't mean that those companies have got Paris-aligned targets yet or realistic transition pathways, but what it does mean is that they're assessing those risks and opportunities, and they're thinking about things like scenario analyses and KPIs and targets. And so, these things are heading in the right direction. And actually, interestingly, the increase in participation is a lot of it is actually coming from APAC. We may be coming from a low base, but actually the growth rate in some of this participation is quite extraordinary in APAC. So that gives me hope.
Yeah, I completely agree with you on Asia Pacific. I think one of our data points showed that, of the companies, and there's about, three or 4,000 that we reviewed globally, the Asia Pac actually had the highest number of companies that were intending to set or had set internal carbon pricing models. So they're already starting to work out, what are the possible implications of having carbon pricing, and what would that mean for their business model. So yeah, I fully agree with you. Jingwei, I wanted to turn to you as well as the rest of the panelists and just kind of throw it out to throw out this question, which is really in terms of opportunities. What are you sort of seeing in terms of investment opportunities or sector attractiveness, and any examples of climate investments that you can give us?
Sure. I don't think I'm qualified to give any investment advice these days, and but happy to share. And also, we truly believe in certain segments will have a higher development path. I think a couple of panelists mentioned that before. Number one is the industry transition. I think there are various industries have to go through a very tough transition period. Heavy metals is one of them. Construction is the other one. I think those will have multiple years of transition period and billions of dollars investment. I think we have more to do to join forces with them at the corporate level to help them through that transition period. I think the second one will be anything to do with carbon credit. I think that credit market started right now in various different forms, but it wouldn't shrink, and it have to go higher. And not only the credit trading platform itself, but also the underlying assets supporting those credit, like forestry. I think that will be one of the areas. I think the final one is some of the industries and the corporate technologies support net reduction. The carbon capture technologies, I think especially invested a few of them, but a really small scale, right? I'm sure that this world needs more and in a much bigger scale going forward. Otherwise, we wouldn't achieve the net zero. So those are the opportunities. If I can say one more thing that's triggered by Ian's comments earlier, when he mentioned about the data from insurance, I think it's an interesting situation that insurance companies being probably not criticized, but questioned whether we share all the data to everyone during the whole climate risk and all this transition period. And we, on the other hand, believed that the insurance coverage, risk transfer, the qualified data analysis not being supported by banks and others. I think both of us probably wrong. I think there's a lot more room for collaboration and joint forces to change the underlying economy, so that then there will be more global standard, global understanding towards the same goal.
Can I just build on that actually and say that I think there are sort of two approaches to looking at the opportunity set. So one of them is some of the very clear sort of green aligned or climate aligned solutions. Jingwei just mentioned CCS, for example. Obviously, there's been a lot of interest in renewables in NEV and in those very sort of specific sectors. I would say we also need to look more broadly as well, because we need all sectors to transition here. So I think also digging beyond those kind of clearly aligned greener solutions and looking at what companies are doing within their own sectors to support the transition actually is another really important way, because there are lots of solutions that are going to come from technologies within specific sectors that maybe investors haven't thought about. So I would say it's a pretty broad opportunity set, but you can either look for those clearly green aligned solutions, or you can think more broadly about companies and opportunities in their own sectors. So I think that second subset presents some interesting opportunity as well.
Yeah, absolutely. I know we've got about 8 minutes left, really. I just wanted to see whether anybody would like to pose a question to the panelists. We've got a gentleman there.
Can you hear me now? I'm Chris Briggs from St James's Place. Thank you for all your contributions. I'm not sure who directly I'm putting this question to, because I think all the panelists have probably contributed partly towards the thought process behind this. But my question really relates to whether, in terms of benchmarking, you could see the possibility of there becoming a schism between the E, the environmental, and the SG, the social governance, in terms of how we benchmark funds and portfolios. And I suppose just to put that into context, I'll come back to Emily's point that Emily was referring to the fact that there's increasing science behind a lot of the metrics on the environmental and the climate neutrality investments. Emily even referred to the fact that the kind of wider climate movement is now actually coming behind these scientific metrics. So it's quite clear that when we're looking at climate neutrality and environmental investment opportunities, there's going to be very clear fundamental benchmarks that can be addressed. However, we have E, S, and G. On the social and governance side, clearly more qualitative, as Helena referred to. More opinion-based, more culturally relativist, perhaps. So I'm just thinking of a couple of examples here where this schism could be particularly marked. And I'm not advocating any particular industry and not suggesting any particular solution. I'm just using two examples so the panel can kind of see where I'm coming from. One could be, for example, in the environmental climate neutrality type investment world, I think it could be said that the transition to electric vehicles would be seen as something that could contribute to climate neutrality. I think that's generally seen as a given. However, within the production of electric vehicles, there's obviously the use of things like coltan. 80% of the world's coltan is mined in the Democratic Republic of Congo, and it's unlikely, therefore, that the miners of that essential material are going to meet the social and governance benchmarks of perhaps the UNPRI when their contribution is very important to achieving climate neutrality through the scaling of electronic vehicles. A second example would be the nuclear industry, something of a bête noire in terms of social and governance side, but could perhaps have an extremely important role to play in climate neutrality. So my question to the panel, and I suppose it would be Helena who raised the issue about different benchmarks. It would be how do we address this in order to achieve investments into the right areas that are going to achieve climate neutrality, but they might be laggards on the social and governance potentially.
Shall I go ahead? Look, I think you raise an excellent point in as much as, yes, there's been a lot of focus on the E, part of the sort of the ESG triumvirate. I think for clear reasons that we have a very urgent situation in front of us that needs addressing. I think that's why we have convergence around the E on the climate change. In particular, there's a lot more that comes into that, as you say, around social and governance, and these things are deeply interrelated. In particular, the social part of climate change. So I think we've sort of made a start with the E, and I think there's recognition that climate change in particular is very material, is very financially tangible, and is a great source of not only opportunity but also of systemic risk as well. But yes, there is also, I think, a growing focus on the S and a realization, although somewhat less developed, that we need to be addressing that as well. I mean, I'm just going to mention maybe on the environmental side, when we think about things like the EU taxonomy, and sorry to go back to regulation again, but there's a social component to that and a do no significant harm element as well. So I do think these are things that are being addressed. They're not necessarily easy, right? And when you look down the value chain and the supply chain, there are a number of inherent risks. So it's really, in some cases, how do you balance that out? in a very realistic way. But I completely agree with the thrust of your question. Maybe I'll give a chance for somebody else to respond.
I would like to just mention the way probably we see that is we could prioritize an investor or even advocacy. Either of us could have their own preferences and choice, but the E and the S and G are not necessarily mutually exclusive. And if we would look at the framework like TCFD, it clearly says a lot of the requirement or expectations around governance. Similarly, if bankers look at greening, financing the infrastructure, then there are specific points laid out under the equator principles that you couldn't do this, you couldn't do that. Otherwise, it's not it's not good enough around the so-so. So while we advocate, or maybe we are allocating some of your assets under some transitional or renewable energy sector, by no means we're saying the S or the G are unimportant. That's just my addition, agreeing what you said.
Would you like to add, Emily?
I can try and cover it quickly. Look, obviously, all of the ES, the E, the S, and the G are important, but I think it kind of goes back to what I was saying earlier about how you assess these things from a top-down perspective versus bottom-up perspective. So, climate change is obviously, it's systemic, it's pervasive, and it has the potential to impact markets globally. So that in essence has far more potential to impact the beta of your investments. Whereas what we've found with our analysis and the deep thinking that we've done around these issues is it's quite difficult to pull out an S or a G issue that is quite as pervasive across all markets and all sectors as that is. So typically we have found that S and G factors really have to be approached more bottom up, and they're far more connected to potential alpha drivers in your investments. So that's kind of how I try and think about these things in a nutshell. But obviously, as Helena pointed out, it's far more complex than that.
Thank you. We may have, I'm acutely aware that we're standing between now, lunch and you guys. So is one final question from anybody?
Hi, can you hear me? Okay, great. So I'm Judy from S&P Truecost. So we are not only a data provider, but we also do a lot of the analytics on the climate and environmental front. So I think one question that is natural to me, because we have audience today from the asset management, from bank, as well as insurers, is that we talk a lot about the challenges on data. And I personally also know there are a lot of challenges on data in terms of data quality, the consistency of data, and the context we're talking about inputting and using these data and solutions that we provide. But however, I still wanted to understand a bit more about what are some of the other challenges for asset manager, Emily, and also for insurance company and the bank that we are facing now, and what are some of the solutions as well as the solutions and analytics part that we are thinking about that are something that we can owe together to help and address. Thank you very much.
Yeah, sure. So I'll park the challenge about data because you covered that. But I guess, the other major challenge that we're facing into, and it's been touched on by a few of the panelists, is that there isn't really one single definition of what is defined as a sustainable or a green fund. And because it's not a one-size-fits-all thing, what really needs to happen is very clear labeling, transparency, and not only around the objectives of the fund, but also around the process of the fund, and also, measurement and reporting of the outcomes. So I think regulators have a strong role to play in how they are classifying and defining different types of sustainable investments across the spectrum, not trying to pigeonhole it all into kind of one style that could potentially constrain investor choice, but it really is around transparency and governance of your process and being very clear on what you're trying to achieve with any particular sustainable strategy.
I think I want to direct this question to Elaine, because Elaine, you did touch upon, the SFC already working on this with respect to differentiating ESG and non-ESG data and a labeling of products. So if you could just give us a 1 or 2 minute view, that'd be great.
Well, I'm not going to go into the technical details about the requirements for labeling, but I think the essence is that, if there is a clear objective that is to be achieved with that particular investment, it has to be clearly articulated. It has to be appropriately backed by either how you do it, the methodologies, what sort of metrics are you using to track progress. So the measurement, the description around what goes into your investment process, I think that is important for investors to understand and for the investment firms to bring or bring that to the market. I understand that there are a lot of difficulties with having investors not fully understand what is being communicated. This is a chicken and egg issue. We'll have to educate, we'll have to build awareness, we'll need better disclosures. I think all of these needs to come together.
Thanks, Elaine. And Jingwei and Ian, just your high level, any other challenges that you're facing with respect to environmental or sustainability in general besides the data challenge?
Actually, if I may, one observation I'd like to make, because we need to remember there's a customer at the heart of this, and customers, absent any standardization and agreement across the different industry players as to what's required, customers will be inundated with information. So I really would wish us to come up with some common standards which meet all of our different needs and can apply on a consistent basis.
Yeah, maybe very quick. I fully agree with what Ian said. Ultimately, it's the underlying industry and corporate. What's the inner drive to make certain things available for everyone? If I can say one particular challenge is, what is the deviation between where the industry's pathway will be and what that specific corporate pathway will be? How to differentiate that probably will help everyone to make the right investment or decision. Yeah.
Thank you. I think with this, we'd like to bring the session to an end. I'd really like to thank all the panelists for all of their insights and taking the time to really condense all of these broad topics on climate and environment and sustainability in general into 1 hour. It's never easy. Thank you.
Thank you very much.